Hey, what's up, everybody? Tim Albrecht here, and welcome to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist Podcast, where we feature questions from you, the YFP community, to be answered by one of YFP Planning's fee-only certified financial planners. Before we jump into today's question, I want to give a shout out to YFP Planning's incredible team that makes this segment possible. YFP Planning offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. So whether you want to optimize your investing plan, pay off student loans, or simply build a solid financial plan, YFP Planning will help get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. Okay, this week's question comes from Steven in Sacramento, California.
Hello, YFP team. This is Steven again from Sacramento, California. I've got another nerdy financial question as I try to collect as many comfy YFP t-shirts as I can, in addition to catching up to Alex Barker for a number of appearances on the podcast. So my question today is if you could explain the tax implications each year for brokerage accounts with 1099 forms, long-term capital gains tax, and estimated tax payments to the IRS and to states that have state income tax like California does. Anyways, I'm a huge fan of the show and I look forward to your response. Thanks so much.
Thank you, Stephen, for submitting your question. We featured on this week's Ask a YFP CFP segment of the Your Financial Pharmacist Podcast. Not your first question, so appreciate you contributing on an ongoing basis and your engagement in the community. Tim Baker, what are your thoughts?
There's kind of a lot to unpack here, Tim. So, I think we're asking about, Stephen, you're asking about obviously brokerage accounts, the 1099s, long-term, short-term capital gains, estimated taxes, federal versus state. So I'll try to unpack this as best I can. So when we're talking about a brokerage account, sometimes called a taxable account, these are really accounts that are, kind of outside of the realm of an IRA, Roth IRA, 401k, that type of thing. You're required to pay taxes on that money in the year it's received, not necessarily when you actually draw it from the account. So that's one of the benefits of, money that's growing inside of a 401k is that you're not taxed on that, on that growth. So these earnings in a brokerage account are often called capital gains or interest or dividends. Mm-hmm. And those are often reported, Tim, via a 1099. So you might get like a 1099 DIV, which is dividends and distributions. So you'll get something like that from, your brokerage account. So whether that's with TD Ameritrade or Vanguard or Schwab or whoever that might be. Mm-hmm. You might also get one that's a 1099 INT, which is basically interest income. And sometimes these come all wrapped in one. I know at TD, they're all together, but you can also get these separately. But the INT is just interest income. So like, for example, if you have a high yield savings account, you'll have to report, I think last year I was looking at my statement, it's like $150 in interest income that's taxed, mm-hmm. At ordinary income. You might see a 1099 for miscellaneous income, which might come from like rents or healthcare payments, or it could be a prize. It could be a 1099R, which is sometimes people will see this with people that we've worked with, which might be like an old 401k that doesn't get rolled over automatically. It gets cashed out. Mm-hmm. So let's say you have $2,000 in that, you get a 1099R that you'd have to pay a penalty and taxes on that. Could be a 1099G, which could be for government payments, tax refunds from state or local. And then probably the last one that, might be news to or great for a lot of our listeners is a 1099C, which is a cancellation of debt, which you probably wouldn't get in a PSLF because you're not taxed on a PSLF debt, but on maybe like a private debt or some mm-hmm. type of other debt you would be taxed on. So those are all just forms that the data is reported on, Tim. And what you would do is you would take those forms, and whether if you're doing the taxes yourself or you give it to your accountant to basically input that as in how it gets taxed. So that's really the breakdown of the 1099s. I think to go back to kind of jump back to the, one of the things, Stephen, you asked about is estimated taxes on to the IRS. That's a little bit not unrelated, but you might, for example, Tim, you might have a side hustle that you are paying estimated taxes on. So unlike W-2 income where you're basically withholding tax to send to the federal government or the state, a lot of 1099 income, that's not the case. So you basically have to go and pay that, either write a check or do electronically, every quarter. And the idea is that you do that as you go. So when you go to file your taxes at the end of the year or, Q1 right now, really, There's no really big surprises. You're not having to, pay 20, 30, $40,000 out of pocket. So you kind of pay as you go, which in a W-2 income stream, that's kind of built in, but not necessarily for a 1099. So what you do is, say you have 1099 income and your taxes owed are $50,000, but you've paid $45,000 over the course of the year, then the difference you have to pay when you go to file is $5,000. And that can be both at the federal and the state level, depending on where you live. Again, a lot of these are kind of around the same thing. The last thing I just want to kind of touch on is just the idea of long-term versus short-term capital gains. We kind of talked about a little bit at the beginning here, but just to kind of, finish the question on this, one of the things that we talk about is, how you fill your buckets. And typically it's, if we're talking about for retirement, it could be for, get the match in your 401k and then maybe look at an IRA outside of that and then go back to max out the 401k. The reason that you're doing that is most people from a long-term investment perspective are looking at retirement, but there might be other things that you're saving or investing for that it's not retirement. So say, Tim, you want to buy a cabin for Shea Albrecht that you guys can just retreat, and you want to do that, let's say in 8 years. You might say, well, I could put that in a high yield savings account, or I could, take a little bit more risk, put that in a taxable brokerage account and, put $20,000 in that account.
Right.
And then let that roll. Over the next 8 years, you could put additional monies in that, but you could say, hey, it's going to, in 8 years, it's going to be, let's say $50,000. So in a taxable account, there's capital gains of $30,000 when you go to basically sell those. So what that means is that you're taxed on that. Now, depending on how long you hold it, a year or more, you're going to be taxed as long-term capital gains, which could either be 0, 15, or 20%. Or if you hold it less than a year, so let's pretend that, in 2030, you go to take that money out, but you just put money in maybe, 5 months before that, and you invested it, then that portion, those gains would be taxed at short-term capital gains, which is ordinary interest. For a lot of people listening to this podcast, that's going to be 22, 24%. So if you're looking at, the difference between short-term and long-term, right? For a lot of people, it's going to be about 9%. And then every state is different. I looked at, Ohio. Ohio, they'll tax capital gains on anywhere from 2.8%, 2.9% to 4.8%, depending on your AGI. So there's a lot of states that it could be as high as, I think California's as high as 13%. Some states it's not at all. So there's a lot kind of to unpack here, but I think at the end of the day, it's, this is another area that people are using, to build wealth. And I think, typically if it's kind of outside of the retirement goal that you're investing for, or you've already kind of maxed out those buckets, the brokerage account is a viable way. We always talk about things like real estate and things like that, but it's a viable way to build wealth. But I think, you have to understand, the tax, implications that go along with that you're basically being taxed on cap gains and any interest and dividends you earn along the way, which can be significant in terms of the overall return that you get at the end of the day.
Yeah, and Tim, as you're dissecting the brokerage accounts relative to Stephen's questions and all the tax implications, here we are in the midst of tax season, and I suspect many folks are putting the pieces of the puzzle together of the connection here, obviously, between the investments and the tax strategy. And, we're really excited about the growth of and the work that's happening at YFP Tax under Paul Eichenberg's leadership. And it's not too late if folks are looking for a solution for tax filing, as well as, looking ahead to the future as we think about more of the planning and strategy side. I would encourage folks to go check out yourfinancialpharmacist.com/tax. Act quickly. We're getting to the end of the season of when we're going to be signing folks up for this year to make sure we can get that work done well and on time. And again, that's yourfinancialpharmacist.com/tax. Thanks again for listening to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist Podcast. If we feature your question on the show, we'll send you a super comfy YFP t-shirt. You can submit your question by sending an email to info@yourfinancialpharmacist.com, or you can record your question by visiting yourfinancialpharmacist.com/ask-YFP. If you don't feel comfortable sharing your name on the show, you can send or record your question anonymously. As we conclude this week's Ask a YFP CFP episode, an important reminder that the content in this podcast is provided to you for your informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on this show. Opinions and analyses expressed herein are solely those of Your Financial Pharmacist, unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you for your support of the podcast and have a great rest of your week.